Trump's tariffs under fire. Key economic data to watch this week. Get ready for a rollercoaster ride of economic revelations. This week, a barrage of critical economic data is set to put President Donald Trump's tariff strategy under the microscope, offering a crucial snapshot of the U.S. economy as it navigates uncharted trade waters. So far this year, the economy has been surprisingly resilient, defying the dire predictions of many experts who feared the impact of these tariffs. But here's where it gets controversial. A series of key economic indicators and a pivotal policy decision due this week could either confirm this robust performance or signal the onset of a slowdown, according to insights from ABC News. It's an absolutely massive week. Think of it as the economic equivalent of the Super Bowl, explained Michael Jones, an economist at the University of Cincinnati. This is a real litmus test for Trump's tariff policy. Kicking things off, a new report on gross domestic product, GDP, released on Wednesday, provided the latest insights into the health of the economy. The GDP expanded at an annual rate of 3% for the quarter ending in June, bouncing back from a negative 0.5% contraction in the previous quarter. William Hauck, a professor of economics at the University of South Carolina and an expert in international trade, emphasized the significance of the GDP figure. A robust GDP number would be a strong indicator that tariffs might be working, he told ABC News. However, the data isn't as clear-cut as it seems. The government's method for calculating GDP involves subtracting imports to focus solely on domestic production. This means that fluctuations in import levels can skew the GDP reading, masking underlying economic trends. For instance, the first quarter's GDP decline was largely due to a surge in imports as companies stockpiled goods to evade impending tariffs. Conversely, a drop in imports during the second quarter might have artificially inflated the latest GDP figure, analysts noted. Hot on the heels of the GDP report, the Federal Reserve announced its latest decision on interest rates. Market sentiment, as measured by the CME FedWatch tool, suggests a 97% likelihood that rates will remain unchanged. This would mark the fifth consecutive meeting and 7 months since the last rate adjustment. With the federal funds rate currently ranging between 4.25% and 4.5%, a holdover from the sharp increases implemented to counter pandemic-era inflation. The Fed has adopted a cautious wait-and-see stance, closely monitoring the tariff fallout. A decision to keep rates steady would reflect ongoing concerns among Fed policymakers about the potential for significant inflation triggered by the tariffs, analysts pointed out. This decision comes just days after Trump made a rare visit to the Fed, ramping up pressure for lower interest rates. The Fed chair is data-driven, Jones stressed. He won't be swayed by political pressure or presidential directives. On Friday, the federal government unveiled the latest jobs report, shedding light on employer hiring decisions and their confidence in the economic outlook. Economists anticipated an addition of 100,000 jobs in July, marking steady but slowing growth compared to the 147,000 jobs added in June, and falling short of the year's monthly average of 130,000. Corey Staler, an economist at Indeed, summed it up. The labor market. Navigating market volatility. 3-day obstacle course ahead. The global market landscape is set for a 3-day challenge, navigating economic uncertainty and policy shifts. In the world of finance, few things are as unpredictable as the interplay between global markets, trade tensions, and economic forecasts. This week, traders and analysts are bracing for a high-stakes 3-day window of critical data releases, policy decisions, and geopolitical developments that could reshape the trajectory of the global economy. But here's where it gets controversial. While some see this period as an opportunity to stabilize markets, others argue it's a test of resilience amid lingering uncertainties. The trade war's evolving tensions. Despite recent progress in easing U.S.-China trade disputes, the broader trade war remains a focal point. A key development came Tuesday when U.S. officials agreed to extend a 90-day tariff truce with China. Following 2 days of tense but constructive negotiations. However, the road to resolution isn't smooth. President Trump has warned that India's trade deal may not be finalized by August 1st, risking new tariffs. This raises a critical question. Will these temporary agreements hold, or will they spark further escalation? Economic data, the big picture. Global markets have been cautiously watching as economic indicators hint at a mixed outlook. The U.S. second quarter GDP estimate, now projected at 2.9%, reflects a narrower than expected trade deficit, which has boosted growth expectations. Yet, consumer confidence has softened slightly, while job openings have cooled. Meanwhile, the Federal Reserve faces a pivotal decision. Will it maintain its current rate stance, despite growing pressure from within the Federal Open Market Committee? The answer could influence everything from borrowing costs to inflation expectations. AI and tech earnings, a new frontier. As the world grapples with traditional economic metrics, the spotlight has shifted to artificial intelligence. Microsoft and Meta's recent updates have sent ripples through financial markets, with investors eager to assess the long-term impact of AI-driven innovations. But this isn't just about tech giants. Companies like UPS and Whirlpool have also faced headwinds due to trade-related tariffs, highlighting how interconnected global markets have become. The role of retail investors. A fascinating dynamic is emerging. Retail investors appear to be outpacing institutional players in capturing market momentum. This shift challenges the traditional narrative that smart money dictates market trends. As one analyst notes, this could signal a broader change in how markets are driven, by ordinary investors or by elite institutions. The answer may lie in the coming weeks. Controversy in the numbers. One of the most debated points this week comes from the International Monetary Fund's revised forecast, which suggests the global economy is faring better than many feared. While this optimism could bolster investor confidence, critics argue that the IMF's projections may be overly cautious. What does this mean for the future of global markets? And how might these forecasts influence policy decisions in the coming months? What's next? With major economic data releases, Fed policy decisions, and corporate earnings reports on the horizon, the next few days will be crucial. From ADP payrolls to the Bank of Canada's rate decision, every event could send shockwaves through financial markets. As always, staying informed is key. But as the saying goes, the market is a game of timing, and this week, the stakes are higher than ever. Final thought. In a world where uncertainty is the norm, the ability to adapt is everything. Whether you're a seasoned investor or a first-time trader, this week's events offer a valuable lesson. The market is never static. What will you do when the next challenge comes? Let us know in the comments below, because the best insights often come from the people who are willing to speak up.